IRS starts tracking senior homeowners May 1st. Here's what you must do before it's too late. Stop what you're doing. If you're 62 or older and you own a home, the government just changed the rules. And starting May 1st, 2026, your financial situation could be reported directly to the IRS. Most seniors have absolutely no idea this is happening. We're talking about reverse mortgages, home equity withdrawals, and certain property transactions, moves that millions of senior homeowners make every single year. What used to fly under the radar? The IRS now wants a full picture of it. Here's what's scary. If you're not prepared, this could trigger an unexpected tax bill, affect your Medicare premiums, or even reduce your Social Security benefits, all without a single warning letter arriving at your door first. Now, the good news. There are completely legal ways to protect yourself. Seniors who know these rules in advance can avoid the penalties entirely. But the window is closing fast. And if you wait until after May 1st, it may already be too late to act. In this guide, I'm going to break down exactly what's changing, who it affects, what the IRS is now tracking, and the 3 steps you should take right now to protect your home, your income, and your retirement. Let's get into it. What's actually changing on May 1st, 2026? For decades, senior homeowners in the United States have enjoyed certain financial advantages that most working-age Americans don't have access to. You've paid into your home for years, sometimes your entire adult life. You've built up equity. You've watched that investment grow. And for many of you, that home is your single biggest financial asset. It's your nest egg, it's your retirement cushion, and historically, tapping into that asset through things like reverse mortgages, home equity lines of credit, or property sales has been a relatively private matter between you, your lender, and your real estate attorney. That's changing. Starting May 1st, 2026, certain financial transactions tied to senior homeowners are now required to be reported directly to the Internal Revenue Service. Now, what kinds of transactions are we talking about? That's the first question everyone asks. And it's the right one. The new reporting rules primarily target 3 categories. A financial activity. 1. Reverse mortgage disbursements. Specifically, the lump sum payouts and the monthly payment streams that seniors receive when they tap into their home equity through a home equity conversion mortgage, HECM, which is the most common type of reverse mortgage insured by the federal government. 2. Home equity loans and home equity lines of credit, HELOCs, where the borrower is over the age of 62 and the loan exceeds a certain threshold amount. Nagar. 3. Property sales, where the seller is a senior homeowner and the transaction generates what the IRS classifies as a reportable gain or income event. Now, this doesn't mean every single home sale or every single reverse mortgage is automatically going to create a tax problem for you. But it does mean that these transactions are now being flagged and reported in a way they weren't before, and that distinction matters enormously. Doris, why this is happening now? Let me explain why this is happening, because understanding the why helps you understand just how seriously the government is taking this. Over the past several years, the IRS has been conducting extensive data analysis on tax compliance gaps across different age and income groups, and what they found was significant. A substantial portion of senior homeowners who were receiving large sums of money from their home equity through reverse mortgages, property sales, or equity loans were not properly accounting for the tax implications of those transactions on their federal returns. In some cases, this was an honest mistake. People genuinely didn't know that certain proceeds could trigger taxable events. In other cases, the gap was more deliberate. Either way, the federal government determined that it was losing billions of dollars in uncollected revenue every year, and that senior homeowners represented one of the most underreported demographic segments in the entire tax system. The response was to implement mandatory lender and servicer reporting, meaning the financial institutions that handle your reverse mortgage, your home equity loan, or your property closing are now legally required to file a disclosure with the IRS every single time one of these transactions occurs with a senior borrower. In plain terms, the information about your transaction that used to stay between you and your lender is now going directly to the federal government. This is a big deal. And here's why. The IRS receives the report, Sergiu, first. They have the data before you even file your tax return. So if there's a discrepancy between what your lender reported and what you claimed on your taxes, even if that discrepancy is completely innocent and the result of a simple misunderstanding, it can trigger an automatic audit flag. And once you're flagged, you're now in a situation where you have to prove that everything is in order, rather than the IRS having to prove it isn't. That shift in burden is enormously significant for anyone who isn't prepared for it. The practical consequences. You need to understand. Let's talk about the practical consequences. Let's say you took out a reverse mortgage 5 years ago and you've been receiving monthly payments ever since. Under the old system, your lender was sending you money. You were spending it. And as long as you didn't have a tax advisor specifically looking for these issues, it was easy to overlook the potential tax implications. Under the new system, your lender files a report with the IRS detailing the total amount you received in disbursements during the tax year. The IRS now has a number. When you file your taxes or when your tax preparer files them, if that number doesn't appear somewhere on your return in a way that IRS finds satisfactory, their automated systems are going to flag the discrepancy. That flag could mean a letter asking for clarification. It could mean an audit. And if the audit reveals an underpayment of taxes, it could mean penalties, back taxes, and interest charges, sometimes going back multiple years. Now, here's where it gets even more nuanced, and this is critical for you to understand. Reverse mortgage proceeds themselves are generally not taxable income. Let me say that again clearly. In most cases, the money you receive from a reverse mortgage is not classified as taxable income because it's essentially a loan against your home equity. However, and this is a significant however, the IRS doesn't just look at the disbursements in isolation. When they receive a report that a senior homeowner has been receiving substantial sums of money from their home, they also look at the broader financial picture. They look at whether you've been receiving Social Security benefits and whether those benefits have been properly calculated. They look at whether your Medicare Part B or Part D premiums should have been adjusted based on your income. They look at whether you've claimed any deductions that might be affected by your home's financial status. And they look at whether any interest deductions related to your reverse mortgage or home equity loan were properly handled. Any one of these areas can become a problem if your paperwork isn't exactly right. And the new mandatory reporting system means the IRS now has more data points to cross-reference than ever before. Home sales, where most seniors get caught. Let's talk specifically about home sales, because this is an area where a lot of seniors get into serious trouble without even realizing it. Under current tax law, if you sell your primary residence and you've lived there for at least 2 of the last 5 years, you can exclude up to $250,000 of profit from your taxable income. If you're married and filing jointly, that exclusion goes up to $500,000. That's a significant benefit, and most homeowners are aware of it in a general sense. But here's what many people don't fully understand. The exclusion only applies to your primary residence, and there are specific rules about how the gain is calculated. If you've made improvements to your home over the years, those improvements can increase what's called your cost basis, which reduces your taxable gain. But you have to have documentation of those improvements. You have to be able to prove what you spent. And under the new reporting rules, when your real estate closing agent files their report with the IRS is going to know the full sale price. If your taxable gain appears to exceed the exclusion, and you don't have proper documentation of your cost basis and your eligible expenses, you could end up with a much larger tax bill than you expected. Or worse, a tax bill you had no idea was coming. This is the scenario that financial advisors are most worried about when it comes to the new reporting rules. Not that seniors are doing something wrong intentionally, but that they simply don't have their paperwork in order. Think about it practically. If you bought your home in 1985 for $85,000 and you're selling it today for $680,000, you've got a gain of nearly $600,000. After your $250,000 exclusion, or $500,000 if you're married, you could be looking at anywhere from $100,000 to $350,000 in taxable gain, depending on your filing status and your documented cost basis. Now, if you've renovated your kitchen twice, added a deck, replaced the roof, updated the bathrooms, and put in new flooring over the past 40 years, all of those improvements can add to your cost basis and reduce your taxable gain significantly. But you have to have records, receipts, contractor invoices, bank statements showing the payments. Without documentation, the IRS is going to use the numbers they have from the closing report, and the tax bill could be stunning. How this affects your Social Security benefits. Let's move on to Social Security, because this is the area that surprises seniors the most. Most people know that if you work while collecting Social Security benefits before your full retirement age, you may have some of your benefits withheld temporarily. But what a lot of people don't realize is that income from other sources, including investment income, rental income, and in some cases, income related to your home, can affect how much of your Social Security benefit is subject to federal income tax. Here's the rule as it currently stands. If your combined income, which includes your adjusted gross income, any non-taxable interest, and half of your Social Security benefits, exceeds certain thresholds, up to 85% of your Social Security benefit becomes taxable. For an individual, the threshold where up to 50% of benefits becomes taxable starts at $25,000 in combined income. For up to 85% of benefits to be taxable, the threshold is $34,000. For married couples filing jointly, those thresholds are $32,000 and $44,000, respectively. Now, why does this matter in the context of the new IRS reporting rules? Because if the IRS receives a report that you received a large lump sum or a series of substantial payments related to your home equity, and that information increases your perceived combined income, even if the money itself isn't directly taxable, it can potentially affect how your Social Security benefits are being taxed. And if you haven't been accounting for this properly in your tax filings, the new mandatory reporting creates a paper trail that makes those discrepancies very easy for the IRS to spot. There's your Medicare premiums. The IRMA trap. Medicare premiums are another area where seniors can be blindsided. Most people know that Medicare coverage has monthly premiums, and most people pay the standard rate. What a lot of people don't know is that if your income exceeds certain thresholds, your Medicare Part B and Part D premiums can increase substantially under a provision called the Income-Related Monthly Adjustment Amount, IRMA. The income threshold calculations for IRMA are based on your modified adjusted gross income from 2 years prior. So if you had a big income year in 2024, maybe from a home sale, a large HELOC withdrawal, or some other transaction, your Medicare premiums in 2026 could be significantly higher than you expected. Under the new mandatory IRS reporting rules, the federal agencies that administer Medicare will have more accurate data about income events tied to senior homeowners, which means it becomes much harder to fly under the radar when one of these income-affecting transactions occurs. If your premiums go up and you weren't expecting it, that's money coming out of your fixed retirement income every single month. For someone on a tight budget, that can be a genuine hardship. 3 steps to protect yourself. Right now. Now. I promised you that we'd talk about protection, and that's exactly what we're going to do now. Because everything I've told you up to this point is the problem side of the equation. The solution side is actually more manageable than you might think, but only if you act in advance, before these reporting rules create a situation you're trying to undo rather than prevent. Step 1. Meet with a tax professional who specializes in seniors. The single most important thing you can do right now, and I mean this week, not next month, is to schedule a meeting with a tax professional who has specific experience working with seniors and retirement income. Not just a general tax preparer who handles your returns every April. A tax professional who understands the intersection of home equity, Social Security, Medicare, and federal reporting requirements. This distinction matters. A lot of general tax preparers are excellent at what they do for the average working person. But the financial picture for a senior homeowner is genuinely more complex, and you need someone who navigates that complexity regularly. When you sit down with that professional, you want to bring several things with you: your purchase documentation for your home, records of any major improvements you've made over the years, your most recent reverse mortgage or HELOC statements, if you have either of those, your last 2 years of tax returns, any statements from Social Security or Medicare that you've received recently. That package of information gives your tax advisor the full picture they need to identify any potential vulnerabilities in your situation before the IRS reporting system puts a spotlight on them. Step 2. Get your home improvement documentation in order. The second protective step is to get your home improvement documentation in order, right now. If you've owned your home for 10, 20, 30, or 40 years, you've almost certainly made improvements that qualify as cost-basis additions. The problem is that the older those receipts and invoices are, the harder they are to find. Some of them may be in folders you haven't opened in years. Some may be in storage. Some may have been digital purchases that you can pull up in old email accounts or online banking records. Start gathering those documents now. If you've lost the original paperwork for older improvements, your contractor might still have records. Your local building permit office may have records of permitted renovations. Your homeowner's insurance records may show when significant systems like your roof or HVAC were replaced. Any documentation is better than none, and even partial documentation can meaningfully reduce your taxable gain when you eventually sell. Step 3. Review your reverse mortgage or HELOC situation. The third protective step involves your reverse mortgage or HELOC, specifically if you have one or are considering one. The rules around what is and isn't taxable in the context of a reverse mortgage are actually fairly favorable to seniors, but they're also fairly technical, and the new mandatory reporting means the IRS is going to be paying closer attention. If you currently have a reverse mortgage, ask your servicer for a complete transaction history showing all disbursements and any fees or interest charges. Make sure that information is sitting in a folder ready to hand to your tax advisor. If you're considering a reverse mortgage, now is an excellent time to consult with a tax advisor before you sign anything, so that you understand the full financial picture and can structure the arrangement in a way that minimizes any unexpected tax consequences down the road. Final thoughts. The new mandatory IRS reporting rules for senior homeowners, starting May 1, 2026, are real. They're significant, and they're going to change the way the federal government sees your home equity transactions. Reverse mortgages, home equity loans, and certain property sales are now going to generate automatic reports to the IRS. But here's the good news. If you understand the rules, if you get your documentation in order, and if you work with a qualified tax professional, you can navigate this without fear, without surprise, and without overpaying a single dollar. The goal isn't to pay more than you owe. The goal is to understand exactly what you owe, document it properly, and pay it accurately. Nothing more and nothing less. You have a window right now, a window to meet with a tax professional, review your situation, identify any gaps, and address them proactively. Once that window closes, once the mandatory reporting starts generating a live feed of data to the IRS, the dynamic shifts. Instead of proactively managing your tax situation, you're potentially reacting to inquiries you didn't see coming. The proactive approach is always better, always less stressful, and almost always less expensive than the reactive one. Don't wait. Act now, while you still have time to protect yourself.